Once prices form a lower low and lower high, a downtrend has been established. It does not matter what comes first, the lower low or the lower high. Analyze the most recent low and high pivots. Once prices form a lower low, analyze the next rally, and if prices form a lower high, a downtrend has been established. As long as prices are forming lower lows and lower highs, prices remain in a downtrend. Once prices stop forming lower lows or lower highs, it has violated the rules and prices are no longer in a downtrend. Downtrends are not always clean and controlled. As long as prices are forming lower lows and lower highs, prices are in a downtrend. Once prices stop forming lower lows or lower highs, it has violated the rules and prices are no longer in a downtrend. Prices enter a sideways trend once two or more relatively equal highs and equal lows have been established. On pattern A, there is a high point and a low point. Prices rally to the prior high point. Prices reverse in the area of the prior high and form an equal high. The high points do not have to be exact price points. They just have to be relatively equal or a general area. Prices pull back to the prior low point and turn higher, forming an equal low. The low points also do not have to be exact price points. They just have to be in the same general area. Once prices began advancing from the equal low point after forming an equal high point, it became a sideways trend. As long as prices are forming relatively equal highs and lows, it remains a sideways trend. On pattern B, prices are in a downtrend. Prices pull back to the prior low, rally, and form an equal low. Prices rally to the prior high and form an equal high. Once prices formed an equal high after forming an equal low, a sideways trend was established. As long as prices are forming relatively equal highs and equal lows, prices remain in a sideways trend. Once prices form an equal high and equal low, a sideways trend has been established. Analyze the high and low points. When prices rally to a prior high point and form an equal high, then decline to a prior low and form an equal low, a sideways trend has been established. As long as prices are forming relatively equal highs and equal lows, prices remain in a sideways trend. Within a sideways trend, prices can form uptrends and downtrends. Look at the move down between A and B. Prices formed lower lows and lower highs, which is a downtrend within a sideways trend. Look at the move higher between C and D. Prices formed higher highs and higher lows, which is an uptrend within a sideways trend. After a strong move, it is common for prices to enter into a sideways trend. Once prices pull back into the area of a prior low and form an equal low, then rally into the area of a prior high and form an equal high, a sideways trend is established. As long as prices are forming relatively equal highs and lows, prices remain in a sideways trend. Analyze pivot points to determine when one trend ends and a new trend begins. Prices decline and form a low point. Prices rally and form a high point. Prices decline and form a lower low. Prices rally and form a lower high, which forms a downtrend. Prices decline and form a lower low. Prices rally and form a lower high. The downtrend continues as long as prices are forming lower lows and lower highs. Prices decline and form a higher low. The rules for a downtrend have been violated, which ends the downtrend. Prices rally and form a higher high. Prices formed a higher high and higher low, which establishes an uptrend. Prices decline and form a higher low, then rally and form a higher high. As long as prices are forming higher highs and higher lows, prices remain in an uptrend. Prices decline and form a higher low. Prices rally and form a higher high. Prices decline and form a higher low. Prices rally and form a lower high. The rules for an uptrend have been violated, which ends the uptrend. Trend analysis never ends. Continue to analyze the high and low points as they form. Trends ultimately take the form of waves. Once a trend has completed 3 waves, the odds are high for a trend reversal. The wave pattern is made up of a professional wave, a continuation wave, and a novice wave. A wave is completed once there is a retracement or consolidation against that wave. The wave pattern does not form in every trend. Most commonly, this pattern forms in a parabolic type trend. The faster a trend is moving, the quicker that trend is running out of steam. A trend that rallies or declines with a 90-degree slope is not sustainable. It's very common to see a three-wave pattern in this type of trend. When a three-wave pattern is forming, it is most common to see three waves. But depending on how strong the trend is, it is also common to see 4 or 5 waves. The most important thing to keep in mind is that once three waves have formed, the odds for a reversal of that trend increase significantly. If you are in a position, this is where you want to become defensive and ready to exit your position. A trend that has a 30-degree slope is very strong and has high odds for continuation. In this type of trend, prices can and do form more than three waves. It is possible to see 7 or even 10 waves at times in a strong trend. On this chart, there are examples of the basic structure of three market waves. Each wave is completed once there is a retracement or consolidation against that wave. Once prices have formed three waves, the odds for trading in the direction of that trend decrease, and the odds for counter-trend trading increase. Combining the waves of a trend with support and resistance can help determine when the odds are high for a reversal of that trend. The structure of waves can link together to form larger versions of the same pattern. The smaller waves are the building blocks for the larger. Once the third wave of the smaller pattern has completed, if the correction against the wave pattern fails to reverse the trend, this correction is setting the stage for the next three-wave pattern. This chart has a three-wave pattern with 4 waves. There is wave 1, then a correction, wave 2, then a correction, wave 3, then a correction. During the correction phase, after the third wave has completed, the odds increase that this trend will reverse. Before exiting your short position or potentially entering a counter-trend long position, there must be other supporting information to suggest this trend is reversing. Prices break down and form a fourth wave. The pattern that forms following the fourth wave is a breakdown failure. Combining this pattern with the completion of 4 waves suggests this trend is reversing. This is the point to exit your short position. The breakdown failure causes prices to rally and form a higher high. This is confirmation that the downtrend is over. Now that prices have formed a higher high, long positions can be considered. This trend completed 3 waves. On the third wave, the range of the bars expanded as prices declined. Compare the size of the bars that make up wave 3 to wave 1 and 2. The bars on wave 3 are much larger. This shows us that on wave 3 the majority of traders believed prices would decline and they were all selling. When prices expand in range after a multiple bar move in one direction, it increases the odds for a reversal of that move. Combine this rule with it forming on the third wave of a trend, and the odds are high for a trend reversal. Once prices begin to stabilize and complete wave 3 is where you should exit your short position. A trend with a 30-degree slope has extremely high odds for continuation. This type of trend can form many waves. Managing pivots in a trend that has a 30-degree slope is an objective way to capture the majority of a strong trend. As long as prices are forming higher highs and higher lows, the odds are the trend will continue.